TheoTrade. This is Don Kaufman. It's May 10th, 2019, and you are watching the TheoTrade Weekend Update. Well, that was a nice week. If you're into volatility, which of course I am, this is the kind of week that you hope for, you wait for, you live for. I'm a volatility kind of a trader. With that, moving forward, again, we're not gonna really dwell too much on this past week of trade, but moving forward, I mean, the markets are really going to have to face some harsh realities. Of course, that's going to put a lot of traders and a lot of investors through quite a bit of turmoil. Let me explain exactly what I'm talking about. In fact, let's get right down to it. First of all, the SPX, and I like to quote the SPX a little bit. The SPX ripped through the bottom of the expected move. For those of you unaware, the expected move, of course, is based on the options markets on a week-to-week basis. Just give you a quick example. This past week, the option markets were kind of depicting about a $34 move inside of the SPX. The actual move is about 64 bucks. So we were just about 2 times, the expected move to the downside. And effectively, the marketplace fell $64 on the week. Now, that amounted to only about a 2.5% move to the downside in the SPX. Not that bad, given the fact that we had some fairly tumultuous volatility, right? In parts of the week, coming into Wednesday and Thursday, I mean, listen, traders, they were starting to feel the fear a little bit. I mean, those volatility futures, as I was talking about in the Wednesday video, really took off to the upside. Things subsided. I'll talk about that here momentarily. One of the disconcerting areas of some of the sell-side activity, though, that we saw this week actually came out of the Nasdaq, and specifically, of course, in Apple. Apple, because of the Chinese, possibility of, the Chinese tariffs impacting Apple's business. Apple actually fell almost 10%, but the Nasdaq really weighed this marketplace down, and the Nasdaq actually fell just about 4% on the week. And that's, again, it's based on kind of a year-to-date basis over there. So where are we at moving forward? One of the first things we need to talk about is the expected move for this coming week. Why? It's expanded substantially. And why does that matter for you? Listen, if you're going to trade, if you're going to invest, get ready, because we're going to have some movement. The expected move, as it pertains to the SPX, you're looking at about a $55 move. That's kind of rounded up, $55 move in this next week of trade. Now, $55 move means effectively we're supposed to close at the end of the week inside of that $55 range. Obviously, this past week we smoked that. We had, a $64 move. I mean, the irony is we were actually seeing, $50 and $60 moves every single day in the marketplace. So we should continue to expect some fairly tumultuous volatility moving forward, especially with a $55 expected move. However, with that being said, because the premium is up a little bit, and because we have a bit of volatility, I think that a lot of options traders are probably going to come out of the woodwork and probably start screaming, "Sell the volatility!" Whoa, whoa, whoa there, cowboy. We ain't even home at all yet. And I'm actually going to show you that. We get to the volatility futures, so I'm just going to tip you off right now. I will not be selling any options premium this next week. Like, listen, I'll sell some premium against stuff that I'm long or stuff that I'm short. Well, me, I'm predominantly short, but I'll sell some premium against, again, positions that I currently have on. But don't think for a second, I'm not going out there and rushing out to sell some iron condor because what? The SPX volatility, ooh, the VIX is in the 16 to the 17 range, bestill my heart. You gotta recognize that volatility, it picked up a little bit this week. We ain't home yet. The next thing you got to really face in this coming week is what we call kind of the merry-go-round of risks. And I've talked about this a lot. So all of a sudden, fear gets going a little bit, and then all of a sudden it starts to perpetuate itself. Effectively, what I want to talk about is, the China trade war kind of kicks off, all right? But that's going to bring up, again, what we call the merry-go-round of risk. And what that means is, all right, so this starts with the Chinese tariffs, which we could hear a lot more about. A lot more about this weekend. I mean, China may retaliate a little bit, maybe take a little shot at Apple. We'll see. A lot of that's priced in. But before you know it, we're not going to be talking about Chinese tariffs anymore. Then we're actually going to talk about the global slowdown. Oh, we forgot about that. There was more economic data that came out this week was not good. If the global slowdown doesn't do it for you, don't you worry. They're going to be talking about the yield curve. That yield curve is between the 3-month and the 10-year. I'm going to show you this here momentarily. Is essentially flat. So we're going to look at some portions in this coming week of an inverted yield curve again. Between the 3-month and the 10-year, everybody goes, well, that's the recession indicator. Yeah, that one's coming around. And of course, last but not least, yes, you do have the trade war in there. By the way, I could go on about geopolitical risk. I can go on the merry-go-round of risks for hours, right? Expected. All right, so we're not going to be talking just about, China and trade war risk. We're going to go much deeper than that in the next couple of weeks, as it looks like, again, once volatility, you kind of light that candle, it sparks into a little bit of a fire. All right, moving forward from there. The next thing I'm going to look at here in a moment, I'm actually going to take you into some charts. Imagine that. The anti-chartite is going to look at some charts with you. I'm actually going to give you a little bit of a bull, a little bit of bear case, and I'll kind of tip you off a little bit on this one. Obviously, part of the bear case is the Nasdaq is falling. The Nasdaq is falling right now, as I said, about 4%, but that is largely based specifically in Apple. The thing that kind of surprises me is some of the other, what we term monsters of tech, or the monsters of tech, your Amazon, your Google, your Apple, and Facebook. It surprised me because the monsters of tech, okay, they all kind of got hammered, yet they don't necessarily have that exposure, okay, to tariffs. Keep that in mind, because what we're going to be looking at here in just a moment are some opportunities for you, okay, if this volatility kind of persists. Now, one of the areas that fared extremely well in kind of this bull bear case happened to be the financials. We are going to be paying very close attention to the financials this next week because they didn't fall below 2650. And if the S&P is going to get rocked, the financials are always part of that program. Effectively what I'm saying, the financials, they got to get hit for the S&Ps to really get tagged. Think about that this next week. Listen, my eyes are always looking towards the XLF, always looking towards those financials. Again, this week they fared well. Tech kind of got weighed down a little bit, which again, a little bit surprising. Apparently the financials have no exposure to China, but some of the big tech stocks do. Again, you're caught in kind of a little bit of a catch-22. Next thing we will look out here, of course, is volatility. As I was saying moments ago, volatility, it picked up. Midweek, people kind of like, whoa, the volatility futures inverted. We're starting to feel the fear. By Friday, though, okay, today, markets rallied back up. But the volatility really got hammered down, which doesn't give me a warm, fuzzy feeling as a trader because, the S&Ps, they bounced a little bit on Friday, which, listen, in sell-side activity, because I'm bearish in the marketplace, doesn't mean I don't ever think a bounce is coming. Of course there's going to be bounces. That's part of sell-side activity. In fact, some of the most vicious moves you're going to see, okay, in down markets are the pops back to the upside. And that's kind of what we got. I mean, listen, we touched down, okay, to a gravity point of 2842, and we ripped off of that, ironically, to a level that I was talking about on Wednesday's video. What was the level? Basically 2883. We closed a hair off that 2883. So we get this ripping 40-point bounce. The S&Ps actually closed up about 15 points, but time out for a second. That isn't exactly a rip and rally, but the volatility really got crushed down. It's almost like this suppression trade. The volatility futures, you feel like they're throwing a wet blanket on a really good volatility party. Better watch out this next week. Those volatility futures are extraordinarily dangerous. The second those things spike, it in effect causes traders to have to sell S&P futures. It's a convoluted trade. We covered it a little bit on Wednesday's video. Effectively, though, watch those volatility futures. If they start taking back off because of some risks that kind of permeate in the marketplace this next week, you can expect a lot more sell-side activity. And last, but of course not least, and we're going to show you this in a tremendous amount, we're going to look at some opportunities, and I'm just going to leave it at this. There are some, what I would term, okay, kind of impervious stocks this last week, or unaffected stocks. You see some sell-side activity going on in the marketplace, and there's a couple of stocks that are just like wandering around, they're looking around, they don't get hit at all. Those are your opportunities. Why are they opportunities? Because if we're going to hit another bout of volatility, sooner or later, marketplaces, they hit them all. Like, if you looked at the advanced decline line this past week, we're hitting bouts of correlation. Correlation is effectively in the S&P 100, okay? On days that we were down, we effectively had like 92, 93 stocks down, okay? There's nowhere to run, nowhere to hide, and that's exactly what you're going to see if we start hitting more patches of volatility. One of the issues that I have right now, I have got to start to look for some opportunities. Why? Because I closed almost everything that I had on profitably. I still have almost every single duration position. In fact, I did not close one duration position. Duration, okay, means in excess of like 3 months. But all my short-term stuff, like my in-out spreads, I even closed like a VIX trade this week. I'm closing, profitable. I pulled a lot of stuff off. Now, okay, I got some dry powder on the side. I have got to allocate. With that, let's get into it. Let's show you a couple of charts, show you a couple of trades, and show you a few opportunities here. Before we dive head on into the charts and some of the trades, TheoTrade 2019 live event. Volatility strikes back. Go to TheoTrade.com/live. We have right now 4 seats that have opened up. There are 4 seats that have opened up. We are just 19 days away from our 2019 live event. Again, our VIP is sold out. Our first tier is sold out. It's a Volatility Strikes Back live event that's going to include all of the TheoTrade instructors. We are kicking that off May 30th right here in Scottsdale, Arizona. It's really a full 2.5-day event. Please go to TheoTrade.com/live. Okay, if you're interested, you got to book your tickets. You got to get into it right now. There are literally 4 seats left in this. TheoTrade.com/live. Any questions? Email us, support@TheoTrade.com. With that, to the charts and trades we go. Allow me to start with a detailed look at a couple of the opportunities, okay, that we see that are really emerging, especially in the midst of some of this volatility. And there's some incredibly important, I think, takeaway points from what I am about to display to you. First of all, okay, looking at this, when you first look at it, and if you're not exactly accustomed to looking at a comparison chart, this is like, the great spaghetti incident over here. It's a disaster, right? Well, first of all, it's a comparison against the spiders. What am I comparing? Well, I'm going to click on this little Erlenmeyer flask. You're comparing the XLU, which is none other than the utilities, to the XLF, which is financials, to the XLK, which is technology, to the XLE, which of course is energy, the XLP, which we get into consumer staples, the XLV, which is healthcare, the XLY, which is consumer discretionaries, and the XRT, which once again is retail. I like a lot of retail in there. Now, this is not every major sector, but to me, it's the sectors that I really need to focus on, okay, for not just a comparison, but general economic kind of well-being. And I'm going to show you exactly why here momentarily. So I'm going to cancel out of there. The next thing I want you to notice is that I'm actually using a 1-year chart. I'm using a 1-year chart because I want you to see how the sectors fare over a year. Looking at this just from like that bottom, okay, in like, late 2018, the bounce from the bottom, or, on a year-to-date basis, I don't necessarily think this does it justice. One of the things that you should first know, okay, and I'll kind of zoom in on this so you can see, all right, what's performing really, really well and what's not performing well. Okay, first of all, let's start with the non-performer. The non-performer is down here. It's the energy sector. The energy sector over the last year, and this is literally, it's like year over year, okay, is down about 16%. Then we come to another laggard over here. That happens to be the financials. Why do you think I'm keying into the financials so much? Okay, the financials, what have they done for us lately? Absolutely nothing. Over the last year, they're down about, almost 3%. Granted, you could look at this on a year-to-date basis, and this is where fund managers, they pop in here, they go, yeah, we're killing it this year. Yeah, this year started from like, an absolute bottom when the S&Ps were close to 2,300, okay? But year over year, those financials not performing well. Then we actually come to the XRT. But to me, some of the opportunities in understanding this marketplace lie up here. This doesn't necessarily pertain to getting short anything up here, okay? But I want you to see some of the top performers, XLP, okay, which we're going to come back to here in just a second. The other one is XLU, utilities, consumer staples. Really? Those have been some of the best performers, okay? Then we come to the XLY, all right? Then you start to get into, and again, I'll highlight right there. Then we actually come to technology. So there's this overwhelming belief. Technology, man, it is the place to be. It's the hottest thing going. Yeah, it's on a year-to-date basis, but year over year, performance ain't so bueno, okay? The one thing I really want to hammer home is that when you start looking at the top performers in here, again, we'll even put consumer discretionary if you want, the top 3 performers, okay, in this category, 2 of them, okay, are highly defensive positions. Okay, the thought is if the economy is going to, well, crap. Let's very, very, very blunt. If the economy is going down, they're going to run into utilities. They're going to run into, again, XLU, XLP. Now let's actually cut to the chase. Take a look at XLP. Why are they running into this? Safe places. And safe places, like if you think about it, a stock like Walmart. Yeah, did you see the rally inside of Walmart today? It's absolutely phenomenal. Why are they buying up Walmart like it's going out of style? Because in the end, all right, everybody's shopping at Walmart when there's nothing left of technology. I mean, that's one of the thoughts that you should have. The other thing you should think about is, these are some dividend payers, about 2%. You start to look over at the XLU. The XLU is a highly defensive sector. Okay, it's paying about a 3% dividend yield right now. The dividend yield is not great. Okay, in this defensive sector right now because of the wicked rally. I mean, look at this thing on a year-to-date basis. Defensive sector like the utilities is up almost like 11, 12%. Again, it just speaks volumes about the marketplace. So that and that alone right there, that makes me very apprehensive moving forward, which starts to bring me to some of the opportunities. Okay, some of the opportunities that I see. First of all, stuff like CSX. Now, I do maintain a short position in CSX. Okay, what is it? It's trains, planes, and automobiles. No, it's just trains. It's transportations. Okay, in the midst of an economy that appears to be just what? Oh, that's absolutely stellar right now. Listen, if there's going to be any economic slowdown whatsoever, if you do believe in that, a short position inside of CSX, okay, is probably viable. And that's just a thought. Okay, listen, I do have a short position on. I'm already rolled out. Okay, I'm rolled out here to the June. I look for about an 85 delta. I'm buying a deep in the money put as a synthetic short position inside of CSX. Now, I can go on all day long about this. Another product that I started looking at recently happened to be eBay. And you're like, what? eBay? Okay, totally unaffected. Really, this last week, there was a little bit of sell-side activity, but generally speaking, completely and totally unscathed, up almost 30% on a year-to-date basis. Don't tell me this is a big turnaround story. Okay, what I'm doing is I'm looking for opportunistic shorts if this volatility is going to, persist. Think about that for a second. Opportunistic shorts. The next one kind of on the docket, Goldman Sachs. Goldman Sachs, totally unimpeded. This one, you really got to single out. Why am I singling out Goldman Sachs? Okay, you take a look at some of the other financials, they did get a little bit whacked, right? The last 2 weeks in Bank of America getting a little bit whacked. JP Morgan getting whacked. By the way, I maintain positions in JP Morgan. I maintain positions inside of Citigroup. Also came off a little bit. All right, you can take a look at Morgan Stanley. Also came off a little bit. Goldman Sachs, again, unimpeded. And I want to keep reiterating that what we're looking for right now is possible short opportunities of unimpeded stocks. Okay, Goldman came off like on a percentage basis. It's absolutely negligible. All right, this week from the absolute highs up 20%. This thing didn't even come down, but like 2% on the week. It's outperforming most of the other financials, and in fact, it's even outperforming, of course, the XLF, which brings me to my next point. You got to take a look at the XLF. All right, the XLF. Here is that kind of line in the sand. This is the 2650. We are well north of the 2650. I mean, come on, people, we're 2750. If this marketplace is going to continue to sustain a degree of volatility, it's going to be done on the back of the financials. The financials are going to have to, they're going to have to give up a bit of room. And when you start looking at the financials, specifically for like next week, what I do want you to see, okay, for next week, about a 19% implied volatility with a 60-cent expected move. Now, how does that compare to the rest of the marketplace? Well, when you start looking at the SPX, okay, the SPX is looking at about a 16 vol. That's why I'm saying, like, let's not get ahead of ourselves and start selling premium. And everybody, like, they run right into, okay, a brick wall. If you start, selling premium at the 16 volatility, things really, okay, in terms of volatility, kind of died down. And one of the points that I want to make when it comes to volatility, and we're actually going to look all the way out here at the 40-day volatility futures. One of the points I really wanted to make, if you look at the 40-day volatility future, that little monkey's trading, that's the June vol futures, trading 1685, okay? Then you start looking at the July volatility. That thing is pretty much 1710. We dropped out of an inverted state. All of a sudden, we actually dropped back to what we call normalization. So the volatility futures earlier this week looked like this, where the risk was heavier, okay, in the near term. And as we went further out, the risk actually subsided. Now, okay, the end of the week, we have just a mild rally. I mean, come on, 0.5% rally? The Nasdaq didn't even really rally. All of a sudden, though, curve actually flattens out a little bit. All right, it's actually a little bit more like that. That's the curve flattened out. And that's one where I'm like, go figure. And part of me believes that this is a, reload. Let's, listen, shorts covered, the market bounced. To cover your short, you buy. The market rips higher. As the market rips higher, everybody turns around and starts selling volatility once again. And you think we're kind of off to the races to the upside. But the one thing that didn't actually say that the risk was going away is the bond market. The bond market, ever so quietly in the backdrop, has just been creeping up and creeping up and creeping up. And I do not want to discount the movement in this bond market at all. Because again, here's the 3-month. There's the 3-month right there versus the 10-year. And right here is where we effectively close. I mean, look, we're at 2.47 versus 2.43. What's the difference of, basically the yield curve is totally flat. I mean, the 7-year is now actually well below the 3-month. All right, the 5-year is well below the 3-month. Things are nutty. Things are downright nutty over here. And this is where, again, we're going to have to start talking about the inversion of the yield curve in just the next couple of days. The last thing I want to show you, and this is something that's, for me, very unusual. As I said, the guy that doesn't necessarily love charts, I'm going to show you a couple of charts here for just a moment. One of the things you're looking at right now, that's the expected move. So we tore through the edge of the expected move, right? We ended the week right there. That's where we ended the week, which is, on a week we're expecting a $34 expected move. What did we actually move? $64. So we basically hit expected move plus another expected move, and here we are. Because we ripped through the bottom of the expected move now we have expanded volatility. But one of the points that I want to make, and I think that I just really want to drive home, I'm actually going to switch over to the spiders over here, is when it comes to sell-side activity, we ain't there yet. It's just not there. No matter how bearish you might want to be in this marketplace, I'm a bear. Okay. When I start looking at indicators, though, first of all, this is the TheoTrade RSI Laguerre. So it's an RSI with a Laguerre polynomial. Laguerre polynomial kind of takes away time. There's also fractal energy in here. Listen, I'm not that into the indicators, but for those of you that are, one of the things I want to point out in this particular RSI, it's not even dictating that we're oversold yet. Not even in a daily. It's not even in a daily oversold situation yet. Okay. If you go over to the QQQ, okay, let's do it. Let's go. Okay. QQQ. You go over to the Qs. Okay. The Qs, they kind of hit oversold, maybe came up a little bit, but forget about a daily. Okay. Net, this move is pretty substantial, right? This move to the upside is fairly substantial. And I think it warrants, pull up a bigger, broader chart. Let's pull up a 5-year. Let's pull up a 5-year and pull up a TheoTrade RSI, okay, in that TheoTrade RSI in a 5-year time period. Okay. And one of the things I want to show you that I think is kind of fun. If you pull up now a weekly chart. In a weekly chart, what are we doing? Oh, we're just coming off of a overbought condition that has been overbought since pretty much umpteen months at this point. So a completely different look. By the way, this is the QQQ is right now, starting to signal the sell, right? If you look at the spiders, the exact same thing actually exists inside of the spiders where, we're just flatlined overbought and we're just now, literally just now coming in a little bit. I thought you guys would find that amusing. For those of you that do take a little bit of a gander at a chart every now and again, not only aren't we oversold on a daily, okay, we're only hitting the sell signal on the weekly. Ooh, fun things to think about this next week. Keep your wits about you. Listen, if you need a hedge, get in the TheoTrade chat room anytime during the trading session. Ask us, say, hey, I need to hedge my portfolio. I'm not comfortable right now, or you need some help. We're there to help you. Or you can shoot us an email. Again, support@theotrade.com. I want to thank everybody for having time to watch this entire video and all of our videos. Have a wonderful weekend. Bye-bye.